Welcome back. You're watching the ET Money Show with me, Kavita Thapliyal. Now, in the world of investments, there are multiple ways to invest your hard-earned money, but for an ordinary investor, these can be highly confusing. And so today on the ET Money Show, we will help you explore and understand the various ways to invest in equity markets. Let's welcome on board Mr. Jayesh, Faria, Regional Head, Motilal Oswal, Private Wealth, and Misbah Baksa Musa, CEO, NJ Wealth. Welcome to both of you and good evening. So today is a very important discussion on how can you make money having a stock portfolio and a mutual fund portfolio. Jayesh, first question to you. Can we have both in our portfolio?
Good evening, Kavita. Thank you for having me on your show, and a warm welcome to all your viewers. Of course, you can have both in your portfolio, direct equity as well as mutual fund, and you can make money through both the routes. And but only allocation depends as an investor on a couple of points. What's your risk appetite? What kind of time horizon are you looking at? What kind of time are you allocating? So keeping those in mind, one can decide whether they want to participate in equity market through a direct equity route or through a mutual fund route. But of course, you can have both of them on your portfolio.
But Misbah, how can one make sure that the investment doesn't get repeated or over diversified? Because that could be a case where you might not land up making a lot of money, or if at all you can, the strategy won't seem to be working well in the long term.
First of all, thanks, Kavita, for inviting me. And to the question, you have asked, my theory is a little different because I meet a lot of young investors and investors who are investing into equity for long, and they are always in a dilemma as to where I should invest, whether to invest into the equities directly or through equity mutual funds. My simple answer to them is that you have to understand first the difference between the two. When you are investing actually into mutual funds, you are actually investing into a portfolio of stocks. They probably say 40-50 stocks generally they hold, and you invest into that portfolio of stocks, which is actually selected by a fund manager who is an expert or a professional who has a team of analysts, probably data miners, and these are the guys who decide actually for you as to which portfolio of stocks you should be holding it. And it gives you a classic diversification even with a very small amount of investment, which you can't even get by investing directly into probably by having 5 lakh or 10 lakhs or even more money. You probably can't buy that diversification. And honestly, as an investor, I always feel that that diversification is the only free lunch in investing, as also said by Mr. Markowitz. So I always feel that if you are an investor who have lots of time available with you for managing your money, who have that expertise, to understand the nuances of large number of listed companies available in the market. I don't think so. As an investor, to a large majority of the investor, if I have to put my things right, having a portfolio of direct equity into that portfolio makes really a sense.
Jayesh, now let's assume that an individual, now Misbah was very correct in pointing that out, that youngsters, especially these days, they want to make quick money, and which is why direct equity really appeals to them a lot. But then let's say that one needs to have a stock portfolio and a mutual fund portfolio. Now mutual fund, people think it's a very slow process of making money, and also the kind of safety net it has, it might not earn you that much as direct equity. Now coming to my question, how can one really balance out having these kind of portfolio? It's very important for you to understand the nature of these two routes where you have to invest. But the kind of rules we follow as per financial planning, that you need to line up your goals, figure out your risk appetite, which you also mentioned, give it a time horizon. Do these rules apply for these both routes that you have in your portfolio, if at all you want to have one?
Right. So Kavita, as rightly my colleague mentioned about young investor as well as the people who are new to market, And as you mentioned that mutual fund is a slow process, or maybe if I can call it a boring process of investing. And that's why everybody wants to look at direct equity, because they think by participating in direct equity, you can make quick money, or at least you can see the progress, either ways, positive or negative, much more faster. And like majority of us Indians, and that's why I think all of us love watching T20, right? Because it's short in nature, you get quick result, and that's what exactly what's happening currently around us. Because people have been participating in direct equity in large numbers, and within equity also in derivatives, futures and options. And the whole objective, or as you rightly mentioned, for all of them is to see quick money, have excitement, and they find all other avenues boring or very slow. So if one has to have both in his portfolio, so it rightly depends on, as an investor, where are you in your knowledge curve? What kind of time are you spending on analyzing this investment? As my colleague said, mutual fund is an automatic process where you're giving your money to a professional fund manager who has a team of research people, experts, and they analyze and create a 40-50 stock portfolio. If you are investing into direct equity, you are supposed to do the same. You're supposed to spend the time, analyze the company, look at what they are doing, how is the business making money, and then take an informed decision whether I want to buy this particular direct equity or no. So depends on investors understanding about this too, is where one can look at. But yes, we also as advisors or wealth managers tell our investors and the people who are little advanced, who spend time in the market, who've been investing, they follow this thumb rule that 10 to 20% of their portfolio, they do direct investment into stocks, and remaining through the help of fund managers. And that's how they divide their portfolio. In that 10 to 20% where they're doing directly, they analyze the company by they being in particular sector or their own business. They have greater understanding of that particular sector or market or a business, and they tend to participate in those companies directly. And remaining part, they use managers who can get them participate into those stocks.
Misbah, which is a very reasonable way of investing, you know, how expensive is to have a stock portfolio and a mutual fund portfolio, talking about your fund management charges and the entire expense ratio. Which route is expensive or less expensive?
See, I think so. You know, the beauty of mutual fund is that a lot of investors are pulling their money into a pool, and then that pool is getting managed by the team that we already talked about. So, no, because of this kind of an economies of scales, which is possible in mutual funds, and being a highly transparent and a regulated industry, the cost structures are very properly defined in mutual funds. So, you know, if I want to understand the current probable median or the so-called average of the expenses which are charged is around anywhere ranging from around 175 to 2%. This is the fee which generally a mutual investor pays to get the money managed by an active fund manager in India currently, which according to me, looking into the potential or the returns that the equity markets have generated in the past, or probably the expected to generate in future, probably it's not a very big cost. And as we built on more economies of scales, these costs are going to come down. Now, when it comes to, and if your question now is that how it compares with the direct, I suppose, you know, it is not easy to, you know, put that numbers in place, because it depends as to, you know, through which broker you are dealing with, because every broker have a different charge, which they charge to the investor. But the most important cost which I feel that one should evaluate is the cost of his own time. Because as my colleague in the panel has also said, and I have also said before, the time needed to manage your own portfolio is Herculean, because you are comparing it with what a professional mutual fund manager is putting in front of you. They are giving full time through a team into this business. If you want to compete with them, you need to have the same time and the same infrastructure at your end to really be at that same level. So I don't think so there is any cost. The cost of managing the money by own self is, I think, so very huge. When you put in the own time, the value of your own time, and probably the infrastructure that you will need to put in to really match what is there currently available in mutual funds.
Yeah, rightly said that, one needs to be prepared for that. But then, Jayesh, one observation, in fact, one very common question that, viewers keep sending us. So, what people think is that they definitely need to have a direct equity portfolio. Now, what they do is a lot of times look at a fund, for example, a large cap fund. They see what other stocks the fund manager has picked up, and then they try and invest in those stocks as well. What is this kind of strategy, and do you think it really works?
So you're right. Majority of the time, investors tend to do this. They try to outperform fund managers, as my colleague said, who's built this portfolio by investing time, energy, analyzing, going through multiple reports, going through balance sheet, etc. And the easy way is to mimic the portfolio which a fund manager has built, and predominantly keeping the cost in mind. As my colleague explained, they don't factor in the cost involved because they think this is easy way out in terms of picking up on somebody's portfolio and building it. What you pay is only one-time brokerage. But what happens in this kind of scenario, because these allocations are not static in nature, a fund manager not only identifies the stock, but he also continuously monitors them, and keeping in mind the quarter-on-quarter performance and various factors, they also change allocation of their total portfolio in particular stock. So that allocation is known to mutual fund or an investor only end of the month. And that also replicating and making those changes, one will cost money and second will require a lot of time. So though it's a simple strategy of mimicking the portfolio of a fund manager and doing it your way, it takes out these two things which fund manager does. One, tweaking the allocation, whether partially or fully. And second, every month monitor those portfolio and make changes in our portfolio also has cost as well as the time lag. So though it's a simple strategy followed by many, but if you look at their returns, the return of the fund and return of the individual mimicking this portfolio will definitely be different than the previous one.
Sum it up this discussion, Ms. Ba, tell me, correct me if I'm wrong. One can have a stock portfolio as well as a mutual fund portfolio as long as you know what is the goal, as long as you know your risk appetite, as long as you know how well diversified you are, even in these two routes of investments.
Extremely, you know what my colleague also had said. My experience with direct equity investor is that generally, as rightly pointed out before also, I think so the biggest pro of investing directly into equity is getting a lot of excitement, right? Because what I understand is that if an investor makes good money, say he make 20% and 30%, which is very much possible from a single stock in a very short period of time, and that gives a lot of excitement to an investor, saying that great, my experience was really good, and he feels that he probably don't need a professional to manage the portfolio and he can do very well because he had made one good success. But actually, when one study the actual cash inflows and outflows from their direct equity investments over a longer period of time, then only you will come to know exactly what kind of returns I have actually made from my investment, which is actually to be done. So barring that excitement, I always feel that this boring way of getting the fund managed by an experienced or a professional is far more better. And I'll just like to put one statistics in front of the audience today, is that in India, mutual funds now have a very long history of track record. At least I have a 25 years of track record, which generally I track on a very regular basis. So currently, 1 lakh invested equally in all the funds which were available 25 years before. that 1 lakh of rupee in 25 years has grown to 95 lakhs of rupees with a compounded annualized return of 19%. That's a past return, of course. That's nothing to guarantee or I'll talk about the future returns. But this is the past returns which mutual funds have generated. And by no means 1 lakh going to 95 lakhs without an investor intervention over a long period of 25 years. I think so. It's something which one should ponder about before deciding whether I should be investing directly into equity or I should be investing through mutual funds.
So I think with that, we need to end this discussion. But then thank you so much, both of you, for helping our viewers decide which is the better route for them. And on that note, let's take a quick break. And after that, let's begin our viewers' financial planning session with Hemant Ustagi.
ये है बायोटीका मॉर्निंग नेक्टर मॉइस्चर।